Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have David Wolf, the CEO of Hamilton Thorne. Hamilton Thorne trades on the TSX Venture Exchange under the symbol HTL and on the OTC under the symbol HTL-ZF. The company is trading at $1.30 with roughly 132 million shares outstanding, or about $172 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks, Trevor. I'm really pleased to have David Wolf, as Trevor mentioned, CEO of Hamilton Thorne. David and Hamilton Thorne hold the honorable position of being the first company we ever recommended through Small Cap Discoveries, and one of the ones that we're very proud to say we recommended because it's done exceedingly well since we did. David, thank you for joining us. As we do with all these little interviews, we love to start off by having the CEO sort of describe what Hamilton Thorne does and why you do it well.
All right. Well, thank you very much, Paul. And Trevor, thanks for hosting this. I always appreciate the opportunity to present our company. So for those of you who don't know much about Hamilton Thorne, I'll just give a brief overview and a little bit about our business and products and where we are. So what we do as a company is we design, develop, manufacture, and market a wide array of products that are used in the assisted reproductive technology space. For most people, and for us, the majority of our business means IVF, in vitro fertilization clinics. So about 85% of our business is selling products into the in vitro fertilization clinic, and even more specifically into the laboratory of the in vitro fertilization clinic. So to make it clear, we don't provide IVF services. We don't do anything that's patient-facing. We don't run clinics. What we do is provide the highly specialized precision instruments and capital equipment, consumables, and services that are used, again, in the laboratory as well in the IVF clinic to improve the outcomes. As Paul kind of alluded, we've known each other for some time. We're a well-established company. We, on our trailing 12-month basis, we reported just over $38 million in revenue. I should add that even though our primary listing is on the Venture Exchange at HTL, we are headquartered in the U.S. And therefore, I think for this purpose, probably the most important part of that is that we report in US dollars. So everything I'll talk about, unless we get into discussions of maybe share price and market cap, will be US dollars. We also have truly a worldwide business. So everything I talk about, if it's talking about market size or market dynamics, I'll try to the extent I can to, well, generally I talk on a worldwide basis, and to the extent it makes sense, maybe give you some specifics about what's going on. So as I mentioned, we're a well-established business, just over $38 million of revenues through 12 months ending March 31, which was our last quarter we announced. Profitable, about 20% EBITDA margin, $7.4 million of EBITDA during that period. We have cash in the bank, and that we ended the quarter with just under 16 million US, again, in cash, which is a small raise in the quarter. So on a pro forma basis, about $21 million in cash. And the reason for that is our growth is based on really two foundations. One is the normal organic growth and product development and just continuing to expand the core organic business, and secondly, acquisition. So over the past 5 years, we've completed about 5 acquisitions. I've completed 5 acquisitions. Most recent one was in August of last year, where we bought a business in the UK that provides some very specialized capital equipment that is used, in this case, incubators, freezers, and monitoring systems that are used in the IVF lab. And that's been a very nice acquisition for us. I guess the other two things maybe to talk about and to kind of give you a sense of the business is the addressable market for our business is about it's well over $1 billion. The overall spend in IVF, again, that's at the patient side, is about a $20 billion business. But our addressable market, which again is the precision instruments, capital equipment, consumables, and services that are used in the lab, we size at about as I said, about 1.2 billion. That business is the market dynamics behind our field are growing well. We estimate that the market for those kinds of products is growing about 7%. We've been growing much faster than that at over 30% compound annual growth rate for the past 5 years. And again, that's a combination of both organic growth, which is well in excess of the 7%, and growth through acquisition. So I think I've given a pretty good summary. If you'd like to dig a little deeper into parts of the business, I'm happy to do so. And
Sure. No, you did a great job, actually. You covered off a couple of my questions, make my job a lot easier. So, David, yeah, we've seen the 5 acquisitions you've done in the last 5 years, obviously a big component of your sort of business strategy. It's always important to have a management team that knows what they're doing with M&A. Maybe give us a bit of your background, because you spent some time doing M&A prior to joining Hamilton Thorne.
Yeah, so I hate to say I'm an M&A junkie, but I've been involved in over 45 transactions in my career on either the buy side, as buying businesses, selling them, and often, particularly the buy side, of what I like to say is the sharp end of the stick, which is responsible for the integration of those businesses into a coherent whole. As most people know, or you might read in the business press, acquisitions don't always work. They're not always additive. I'm happy to say that of the 5 acquisitions that we've done, everyone has been accretive, certainly accretive to revenues and earnings. Everyone has been, in our view, successful. That doesn't imply by any stretch that there haven't been any problems or unforeseen, hitches. But generally speaking, I think we've done, and we have a very active philosophy about this. We've do 2 things that I think differ from a lot of companies that are involved in M&A. One is we source our own deals. So, and we're in a relatively small field, even though it's a $1.2 billion market. There are well less than 200 players. So, it's fragmented in one respect, but not hundreds or thousands and thousands of players. So we tend to know them all pretty well, have some level of business relationship with a lot of them. I would say in 1, 2, 3, nearly every one of these acquisitions that we've done, we had previously either resold their products, they had previously resold our products, or we'd collaborated in some way. So it's a level of knowledge from a business perspective. So we're not typically just buying a spreadsheet and buying a set of financials. We're buying a business that we know well. Also, we really focus, even as part of our due diligence, on the integration. So our due diligence team is typically the same team that's responsible for ultimately making sure the business works. So we don't have this kind of classic problem you have certainly with much larger companies. And a lot of time with private equity, you've got kind of a deal group. And then when it's time to make it work, they toss it over the wall to the operations group and say, okay, now here, we delivered this great thing to you, go make it happen. And we have the operations group really do the due diligence. And I won't say we walked away from more deals than we've completed at the due diligence phase. We've certainly walked away from more deals at some stage than we've completed, but we're not afraid to terminate a deal during due diligence if it just doesn't make sense for us. And I think, again, the results speak for themselves in terms of the quality of the transactions we've done and the success we've had with them. No,
absolutely. I think when we started following you guys, I actually got my notes here somewhere. Let's see. Yeah, you were doing about $8 million US in revenue, and now we're doing close to 40 million. So you've obviously grown it nicely, and I think in that time frame you may have doubled your share count. So you've managed to sort of really do a good job of keeping growth on a per share basis pretty solid. So M&A is, usually there's a number of different reasons why you do M&A, but give us a better sense of what you're really trying to drive at. And what I mean by that is, sometimes you want to have your salesmen be able to go in with more products. So you're buying the product line to do that, or sometimes you're looking at geography. Maybe give us a sense of what you're trying to accomplish with M&A.
Yeah, so I would say we have a very clear strategy on M&A that really informed our first transaction, which we did in the 2015 timeframe, and everything we've done since then. We've maybe refined, frankly, some of the ways we talk about it, but the motivations are the same. So first of all, we want to increase the size and scale of our business. As you mentioned, Paul, when you first got to know us, we were about an $8 million business. I think we were probably at that point, we were at a little bit of an inflection point, but maybe making $400,000 or $500,000 in profit. So, kind of a 5% EBITDA business. And we concluded, it wouldn't be, frankly, if I were the sole owner of that business, it would be a bad business to own, put the money in my pocket, have a nice little life. But as a public company, we really had to do something more substantial than that. And frankly, because we're a public company and have the currency, we had the opportunity to do so. So one is clearly increase size and scale of the company and get operating leverage. So we've moved from kind of a 8 and 500,000, 5% EBITDA business to now we're roughly 40 million, 38 million and 7.5. So, kind of a nudging 20% operating margins for these EBITDA margins. So it's very clear there's significant operating leverage. We don't try to maximize operating leverage, so I think that's pretty clear. We're continuing to substantially reinvest in the business, and I'll talk about that maybe as a separate item because I'll stay on the M&A part and then get back to it. The second thing is very much what you discussed about having more in the bag. So the idea is we wanted to expand and complete our product portfolio so that ultimately we can fulfill our long-term vision of being able to provide everything that is of high value. We're not really interested in the commodity products, maybe things like gloves or certain kinds of plasticware, but all the high value specialized products that are used in the IVF lab, high value, probably in this case, the specialization implies high margins, that we can manufacture ourselves or through contract manufacturers, but sell under our own brands, obviously with the margins that entails versus reselling other products, and really be able to have the completeness of the package to get both, kind of customer relationship, customer intimacy, as well as, some of the opportunities you have around bundling and other prices, and just basically more share of wallet. And then lastly, we wanted to improve what we now call the quality of revenue. So when you first got to know us, we were primarily a capital equipment business, which is a great business, high ticket prices, high margins, has some lumpiness to it, which can be problematic from time to time, but still a great business. But we didn't have much in the way of recurring revenue. So a couple of the transactions that we've done, we bought a services business and a pretty big consumables business. So today we're about 55% equipment and consumables and services, which very much have a recurring revenue element to them. Either contractually based recurring revenue, whether it's a long-term contract or a year-long purchase order for consumables with drawdowns. But also we have long experience at this and seen that the customers tend to stick with the products that they buy from us as long as they're happy with the products, happy with our service, and everything else. So, I think most people would agree that having recurring revenues is a better thing to do. And then lastly, we also, as part of our vision, is we want to sell more and more of the products that we have direct. So we've been significantly expanding our direct sales teams. We now do direct sales in most of North America. So we have a team that's located around primarily in the US, but supporting US and Canada. We have a direct sales team and warehousing operation in Germany. That it has teams in Germany, Austria, and then we just launched this year. Turned out because of COVID, maybe not the best timing, but it's a long-term strategic decision, and we're still, we still think it's the right thing to do. We're happy we did it. Launched in France, which is one of the top 5 IVF markets in Europe. And as I mentioned earlier, we bought a business in the UK. One of the motivations for that, by no means the only motivation, was to have a platform for more direct sales in the UK. So that business has today a small direct sales team, and we intend to increase that pretty significantly. We had really intended to do that in Q2, but we put it off for a quarter or two, again, because of trying to make sure that the customers are ready for us. But we've extended some offers, and we're expecting by the end of Q3, early Q4, we'll have feet on the ground in the UK as well. So we'll have the top market, one of the top markets in the world, which is obviously US, 3 of the top 5 European markets, and then over time we would expect to continue to expand direct sales as well. So when you go back, kind of summarizing it, our acquisition strategy is based on increasing size and scale, filling holes and gaps in our product portfolio, and improving quality of revenues.
Okay, so you touched on sort of my next question. Obviously, you've got a bit of a war chest now. You have roughly 21 million in cash. I guess, where are your weaknesses, or what kind of holes do you want to fill next through M&A?
Yeah, so the our business, as I mentioned, is about let's say 45% capital equipment, because that's our heritage. That's where we come from. We actually just did a capital equipment business acquisition. But if you look at the industry as a whole, capital equipment is about 25 to 30%, and the vast about 60% is consumables. So I think in general, you should see both growth in our consumables business through a combination of organic growth. Now that we have more direct sales, we can begin to offer some of those consumables in areas where we hadn't offered them, particularly in the U.S., where we're in the process of getting FDA clearance for the the largest category of consumables that are sold in the IVF clinic, which is cell culture media. And then on the acquisition side, there are some gaps on the consumable side in terms of probably cryopreservation is our most significant gap. So if you think of what goes on in an IVF clinic, not to get too technical or too biological, but yeah, egg and sperm are combined in a dish. You typically have, let's say, maybe 8 or 10 or 12 eggs. Say develop over a period of 3 to 5 days where they're nurtured and examined and watched. Not all develop perfectly, but at the end of the day, you end up with usually, not always, enough good-looking viable embryos that maybe they have genetic testing that tested positively. The standard of care today is moving towards 1 implantation per cycle. So the idea is you don't want twins and triplets, which are difficult for the mother, who's typically a little older, and certainly difficult for the babies. Low birth weight babies are not generally healthy. So the rest are frozen. So the concept of cryopreservation, which was kind of interesting, but not always done, is now very, very central. And in fact, people are now also cryopreserving their eggs in order to do that if they're not ready to have family in their 20s, maybe you cryopreserve your eggs in your 20s and then think about 30s. So that's certainly one of the consumables areas that we have a lot of focus on. On the capital equipment, we actually have a pretty full suite of capital equipment. We do have one gap in something called basically a workstation technology, which is a kind of a hood that you might see if you look at science fiction movies where people put those gloves inside those chambers. The ones that are used in IVF clinics are not quite as fancy as that, but nevertheless, you want to be able to maintain a barrier. It's usually done by airflow, a laminar flow barrier, but a barrier between what goes on inside that chamber, where you've got you're maintaining heat, you're maintaining maybe humidity and other things, and what happens to be going on in the room. And then on the one area we haven't really put a lot of focus on in the past, but I think is an area we really are looking at, and like to be able to see us do a transaction, is on the software side. And that is software that is used in the laboratory to manage maybe the lab activities themselves. There's some specialized software that is used in IVF labs to make sure that embryos don't get mixed up. You don't end up with the wrong embryo and the wrong mother, which would be something that has happened, very rare, but the implication of that is obviously pretty significant, as well as EMR systems and EMR system integration. And since that business, going back to what motivates us, is moving away from not completely, but is moving away from on-premises, single license systems. It's more like our equipment business, and moving more to software as a service business with a long-term recurring revenue. I think it's another area where it can really help on all of our fronts, increase our scale, add to our products, and improve the quality of revenues.
Mm-hmm. Fantastic. Okay, so that's plugging the holes, but what makes you guys, if there's one thing to really describe your strength, what makes you guys better than others?
So let me kind of describe the landscape of suppliers to the laboratories. So there are, and I don't know if I should post or give you the link to our website, which is hamiltonthorne.ltd. That is the sort of the corporate investor website. We also, just for confusion's sake, have hamiltonthorne.com website, which is the US-based marketing website. But hamiltonthorne.ltd, you'll find our investor presentation on that. You'll see a slide that actually describes pictorially shows what I'm about to describe. The way the market is set out, as I mentioned, is there are about a $1.2 billion addressable market. There are 2 relatively large players compared to us, over 100 million each of revenue. So while bigger, neither of them is by any means a dominant player. Even collectively, they're less than 25% of the entire market. There are 8 total, including us, companies in sort of the $20 to $40 million range, and vast majority of the companies are 150 plus, are 10 million less, most are 5 million or less in revenues. Just to give you a sense of the timeline, which we sort of alluded to before, even as short as 5 years ago, we were one of those sub $10 million businesses. And now we're breaking out of that mid-tier of 20 to 40 to become the emerging challenger to the big guys. So on any given day, we compete with virtually everybody in that ecosystem at some level, whether it's we're competing directly with them if we're doing a direct sale into a market where we have direct sales, or we're competing with them on an indirect basis through one of our distribution channels, or in the case of one of their distribution channels. In general, what differentiates us from nearly everybody in the market goes back to what I said, which is our long-term vision, to be able to provide everything that's used in the IVF clinic's laboratory. So a broad suite of products, and be able to do it to the maximum extent possible through a direct sales and support team. So nearly everybody else in the market is much narrower in both product and geography, and doesn't seem to, today have the ambition to try to do that. Obviously people are expanding their products, but we've gone from being really a 2-product business to a comprehensive product suite, not complete, but a comprehensive product suite over a 5-year period of the 2 larger guys. One is pretty similar to that, and then I'll talk about the differentiation at a couple of other levels. And the other one is, and all of the others that are in that mid-tier are much more narrow in the products that they sell, and appear to continue to want to be fairly narrow in the products that they sell. And then I think, so that's how we're kind of differentiated in the market versus in terms of capabilities and product and service offerings. In terms of our approach, I would say we're fundamentally focused on quality, but we're in a market which is highly regulated, so the product quality of nearly everything sold into our market is decent. There aren't any products, there aren't, you can't survive in this business if your products don't work. But that being said, there are significant technical differentiation between the products. So at a high level, we position our products as premium products with the best performance, and whether that performance is depending upon what the product is. If it's capital equipment, it's maybe ease of use and reliability. If it's consumables, it's safety and efficacy in dealing with the precious cells that we deal with, embryos and eggs. And then in services, it's obviously that we do the things you need to do in services. We show up on time, we get the service done quickly and done efficiently. We also make a significant investment, about 6 or 7% of sales, which equates almost to 20-25% of profit, is invested back into R&D to continue to innovate, to continue to improve the products that we sell. And then on the services side, which I alluded to, I think we're the only, there's maybe one that really has even an ambition to do it, but I would strongly argue on the execution side, we're the only company that can really provide the significant suite of services that a laboratory needs across the broad product lines of what is sold, whether it's our products or other people's products. And we've invested in that as well. We have a sales and support infrastructure in the US that's almost as large as almost all of our other competitors combined. So we're way over investing in that, if you want to think of it that way. At least the ones who can do the kinds of things that we do. Similarly, in Europe, we're gearing up to invest at that level. We've done that in the German-speaking markets, which is one of our big markets, and adding that in France and the UK. So we're willing to invest in essentially growth on both from a people perspective, whether it's sales and support, ahead of the revenues. And that has an impact on EBITDA in the short term, and an impact on generating some of that operating leverage that I talked about. But we still think it's just so early in the game. It's such an highly fragmented field, that we have a real opportunity if we go at this hard, to be able to balance reasonable profitability, but to push as much as we can back into growth, and as I said, become one of the big three that ultimately tends to in most fields, when you have the consolidation, that's where the winners tend to be.
Let's talk about the industry as a whole. You had mentioned that I think you said sort of the IVF or assistant reproductive industry is growing at about 6%. Is that what you said?
7%. That's okay. the product side of it. The services side is growing. It's hard to know, but roughly in the same. Yeah.
Okay, so we'll call it high single digits. You guys are managing to grow organically at 11% plus. Obviously, with M&A, you're growing the whole business better than that. But what's driving? Like there's obviously demographics. There's I understand there's governments now that are incentivizing more, sort of increase in household size and all that whole thing. But maybe talk a little bit to some of the demographics and some of the political movement and funding.
Sure. So one of the reasons that we, really like this market is that there are strong growth drivers that are, multiple tailwinds, none of which seem to have any likelihood of diminishing. Again, over the long term. Maybe we should at some point talk about how we're faring during the COVID situation, which is a little bit different. But over the long term, these long-term trends aren't going to change. So what is driving the growth in assisted reproductive technologies, in general, IVF in particular? So there are a number of factors that lead to some level of infertility. And just to give you a sense, about 1 in 6 couples, or families, I should say, be more inclusive, 1 in 6 families have some kind of fertility issue at some point in their life. It can be caused by things that are purely physiological and may be treated with drugs or surgical interventions or medical interventions. It can be lifestyle, and things like smoking and obesity all have a negative effect on fertility. But by far, the trend that is driving the significant growth in our field and the significant continued need for fertility is that families are waiting longer to have children. And particularly for the mother, fertility, which stays relatively stable at whatever rate of, whatever it was, it might not be perfect, might be somewhere in this continuum, during the 20s, declines pretty significantly in the 30s and falls dramatically in the late 30s. And what most people have seen, certainly most North Americans have seen, whether you're friends or families or colleagues, is that as people wait longer to have kids, you just have more issues and find themselves, needing to go to clinics. One of the other big trends that's a little less obvious is, so obviously in North America that's the case, in Northern Europe that's the case, in most of Europe. But in the developing countries, you wouldn't think there's necessarily a big need for IVF. In fact, societies tend to be more fairly stratified. So let's say India is an example, which is a very high birth rate. So they don't have government programs trying to encourage birth rate in general. But in that society, if you're growing up in a rural area, you tend to have children pretty young and typically don't have a lot of issues having kids. But if you are in one of the big cities and working in a professional environment, you behave a lot like a North American and spend your 20s and early 30s getting your advanced degrees, establishing your career, getting financially independent, and then you decide in your early, mid, late 30s, whatever it is, that you want to have children, and you have the same physiological issues that everybody else has because of the nature of our bodies. So we're seeing, just to give you, so India as an example is an IVF that in terms of the number of procedures that are done on an annual basis, it's just a little bit less than the US. Now the population is so much bigger, so on a per capita basis, it's still, still small, but just to give you a size of the market. So it's a very big and very rapidly growing market. So the other couple of things that are growing the need for those are what's sort of driving the need for IVF, and some other things that are driving a little bit more of the demand for IVF is government support and government expenditures, whether it's direct outlays to the clinics or to the families, or through insurance mandates or government support. It's very clear that in countries where there is strong government support or insurance coverage, the level of IVF is significantly higher. So in the U.S., again, market I would know very well, 1.7, 1.8 kids per capita, so less than 2% of all births, still a pretty big number at some level, are born through some kind of assisted reproductive technology intervention. In Massachusetts, where I happen to live, which is one of the less than 10 states that actually has really decent support for IVF, it's nearly double that on a per capita basis. If you go to Denmark, which is a country, by the way, that also has a much older cadre of women who want to have kids, so therefore, that part of the need is exacerbated. Tremendous support from a government perspective. It's round numbers 8% of all kids. So kind of a 4x usage, and clearly the government support is a big deal. So what we are seeing, it's I don't want to. It's not a tsunami of effects, and don't look for and it makes my metaphors. Don't look for a hockey stick, but we are seeing certainly in the U.S. Some meaningful changes in the support for IVF. We're not seeing anything at the federal level, as you can imagine. That's a complete paralysis on the healthcare front for the time being. But states in the U.S. typically set their own mandates. So New York, which is a very big population state, recently, as of January 1 of this year, added a mandate for large employers. Anybody with over 100 employees has to offer IVF coverage, and it's a pretty decent benefit. So, that adds some number of millions of people who are now covered by IVF, and would, again, additive to the overall demand. Probably even more interesting is a trend that's happening with large employers who are either self-insured, so therefore in some ways out of the mandates, and or in states like California, which is kind of surprising as a progressive state that they have very little support for IVF. But if you're in California, you have, let's say, a technology business, and have a lot of knowledge workers, where the model is find people in their 20s, really talented, really driven, want to spend the next 10, 15 years building their careers, not interested maybe in having children, but not want to foreclose it completely. So you're seeing big companies like Google and Facebook begin to offer, through third-party benefits providers, supplemental IVF benefits and supplemental egg freezing benefits to help their employees be able to bridge that time gap. Right now, there's about 2 million employees covered by that, right in our sweet spot, right? The kind of people who are ready to either freeze their eggs or thinking about having kids. So, it's that and that's growing pretty rapidly. So we view that as those are kind of indications of the kind of support that you see growing more and more.
I'm glad you brought that up. I was going to bring that up because I think Google is one of the companies that is starting to, either they've done something like that, or they've announced, or they're thinking doing something like that.
No, so Google has supported this for at least a year, as far as I know. Now, whether they do it with every employee in every location, I don't know the answer to that. But there's certainly it's part of what you need to be competitive to attract and retain. That's specialized talent.
Yeah, no, very interesting trend. Okay, so we did touch on COVID. So 2 questions in relation to COVID, but you mentioned a little bit about this, but what has it done as far as the operations of the business? And then any impact you see in the future? Is there an opportunity you see, or maybe is it going to hurt the industry? Give us a little bit of both.
Sure. So we have physical operations and personnel, as I mentioned, in the U.S. and in two different locations in the U.S. and 2 different locations in Europe, as well as people who are remote, primarily salespeople working out of lots of different locations. During the entire, last 6 months, our operations have stayed open, because we've been deemed to be one of the essential services. We provide medical products that are used in clinics, as well as, though, as I mentioned earlier, IVF is the majority of 85% of our market. The other 15% is people who are doing drug discovery and assisted reproduction for food production. So we've clearly qualified as a business that is deemed one of the essential businesses. So we've been open during this entire period. We certainly took the safety precautions you would expect. So the remote salespeople and a lot of the other office staff were able to work from home. I work from home nearly all the time, not all the time. And but we, as I mentioned earlier, we deal with physical goods. We manufacture those goods, we ship them, we test them, we support them. So there's a large part of our workforce, which I am both very grateful to say has been showing up to work very diligently and doing the jobs they have to do, and very happy to say we have had no, in our direct workforce, we've had no instances of any COVID infections that have affected, directly the workforce. Obviously, people have had relatives or friends that have been impacted, which is, a whole different issue. And so we've continued during this entire thing, which I think has helped us. Certainly with one part, when COVID first hit, everybody was very worried about supply chains. Our supply chain is going to fall apart. Well, we've had some supply chain issues, but nothing. Certainly nothing hasn't been fixed, nothing that's been really serious. And I suspect it impacted people more who, in fact, closed down for a month or two than it would impact us. We're our purchasing people, again, maybe working in the office, maybe working remotely. We're nevertheless able to stay in touch with our suppliers. And the fact that most of our suppliers, since they're supplying either finished goods, components, or raw materials that are used for medical devices, we're also able to stay open for the most part. So we've had very little on the supply side. Demand side is obviously, as you can imagine, a lot more challenging. We have, as I mentioned earlier, a worldwide business. So in the first quarter, we saw our sales in China drop off a cliff, as you would imagine, as China typically closes for a couple of weeks in the first quarter each year for New Year's. In this case, they closed late January and didn't reopen for the entire quarter. So we saw near business go a very, very, very precipitous drop in China. In the March particularly timeframe, as the effects of the pandemic spread from east to west, we saw Europe begin to be severely impacted. Some markets, France and Spain, for example, were shut down almost completely. Germany, which is a big market for us, was impacted negatively, but not quite as negatively as some of those markets. It's in part because a lot of the clinics there are not operated out of hospitals. So hospital-based clinics were much more impacted, in part because in the middle of an epidemic who wants to go to a hospital, but also because the clinic staff were in fact grabbed out of the clinics and pushed into working in either the emergency rooms or supporting the people who would normally work in the emergency rooms. But in any event, it's much more severely impacted in certain markets. And also the scientific bodies that sort of, I wouldn't say govern, but provide the guidance that most clinics pay attention to in the US and Europe, advised clinics to either certainly to slow down operations and cease starting new procedures and continue to run them during the process you were in. So we saw a pretty significant decline in Europe, and then a month later into parts of the US, and you're still seeing that kind of play out a little bit. In late May, and May, I should say, that the ASRM and ESHRE, which issued the scientific guidance, both reversed course and concluded that, as most of the clinics believed, and even some clinics who just never closed during this period and went full steam ahead, that what the clinics provide is not elective surgery. It's an essential service that's fulfilling a basic life need, both for the family and for the preservation of our species. And change their guidance from slowing and reducing procedures to how do we reopen as quickly as possible in a way that, again, is safe. So we've seen, I would say with pockets and exceptions, pretty much the entire world is reopened at this point. Not everything's running at full speed. The areas where we do have data, so in China, for example, as I said, we went, fell off a cliff in Q1, bounced back in Q2. In Germany, where the governing bodies that issue. So one of the things about our field is that I actually like about it is nearly every country has a national registry where every clinic puts into the registry exactly how many procedures they do, how successful they are. So from a marketing perspective, you don't have to guess like who are the big clinics, who are the small clinics, who are the successful clinics, who are the unsuccessful clinics. The data is all there. So it makes the marketing side of it great. But also to answer this specific question, we know because the German groups started to issue monthly data as opposed to annual data. So on average, there are about 8,000 cycles per month done in Germany. In March and April went down to about 4,000 or 5,000. So cut pretty significantly, not to zero, but pretty significantly. And then in May and June, up over 10,000. So people who went away, came back, pent up demand. I have anecdotal information about that in the U.S. that we're seeing that in some places. We're seeing other U.S. particularly on the West Coast. I assume the same thing in Canada. I don't know for sure. There's a lot of medical tourism, particularly from China. That has dropped off pretty significantly, as you would imagine. Thailand has a lot of medical tourism that has dropped off, but in the major markets that are serving the domestic patient base, we are seeing a return to normalcy. I don't have a crystal ball, so I can't sit here and tell you exactly how that's going to play out in every market. I can easily imagine, and there's proof during recessions that people are more cautious about having kids. Though in the 2008, 2010 recession, IVF was pretty stable during that period. It's like a 1% drop in the U.S., grew in Europe even during that period. So so there's good indication that it's not completely recession-proof, but recession-resistant. And then of course nobody knows exactly what's going to happen whether there will or won't be a further return of really significant illnesses or lockdowns. But we feel that clearly over Q2, just to be clear, we've been very clear with this. Anybody's asked, it's not going to be a great quarter. It's not going to be a horrible quarter. It's not going to be a great quarter. We're going to have a down quarter. Q3 should return more to a more normalized quarter. But we're in the middle of it now. Anything can happen, and Q4 has a little more crystal balling than I'm comfortable with. But I do feel very, very comfortable that over the long term, that this will pass. Whether it's Q4 or Q2 of next year, I don't know the answer to that, and that the kind of the inexorable growth tailwinds that are driving our business and driving the growth of the field in general will continue to will reassert themselves. And we'll continue to drive the long-term growth of this business. So short-term, choppy waters. Long-term, yeah. I don't want to say clear sailing, but there's no reason it shouldn't continue to be just a very strong growth business.
And obviously, over the last year or so, maybe even a little bit longer, we've seen issues around U.S. and places like China as far as trade issues. Are you guys affected by any kind of trade issues with any areas?
So we haven't been affected in any meaningful way. For the most part, the products that we sell are low tariff products, so a lot of the tariff issues haven't been affected. We don't, as you would imagine, we don't import a lot from China. Maybe some small electrical components are used in other materials, but not, it's not. So we haven't been impacted by that. These concepts of trade wars aren't great. Clearly China is, I mentioned India a little earlier, but China has different dynamics, particularly on child policy, but is a very large and growing IVF market. And China is an important market for us. Not, about 20% of our business is in Asia Pac, and China is not the majority of that by any stretch, but is one of our larger markets, not our largest. So it's an important market for us, and we see growth there. So we want to do more in China. So frankly, the current environment is not encouraging for that. I won't get into the politics of whether it is or isn't a useful thing to be spending our time on, but it's, it hasn't had a negative impact on us, but it certainly hasn't had a positive impact on us.
Gotcha. Okay, let's talk a little bit about the stock. Roughly 131 million shares outstanding. Give me a sense of insider ownership, maybe institutional ownership. What kind of breakdown do we get there?
Yeah, let me just give you one number. We did an offering in, we raised about 5 million US, so 7 million shares in June. So it's really right now about 138 million outstanding.
Okay, right.
So that's still under restriction, so it doesn't show up in all the counts. So 138 fully outstanding. Insider ownership, I mean, I would say ownership in general is one of the things that we both put some work into and, been fortunate. We have strong insider ownership. About 25% of the business is owned by directors and officers. So not everybody likes that. No, it's one of your key things you look at, but strong aligned interests. We're all interested in doing the same thing, which is building shareholder value. And let me digress and then come back. And as you mentioned, when we over the period of time that we quadrupled the size of the business, and I don't know, I mean, our share price went up from probably 10 cents to $1.30, so whatever that is. We did double our share count, but we're very cognizant that if we go do acquisitions or whatever we do, if we raise share count and valuation in tandem, we haven't accomplished anything for shareholders. So we're not afraid to go issue shares. We're not like completely anti-dilution, but we certainly understand that it's ultimately per share to I mean, a lot of things matter, but whether it's sales per share, earnings per share, EBITDA per share, that's what is going to, that and as well as the multiplier is what drives value. In terms of the rest of our ownership, about half of our ownership, so 50% of total ownership, is institutional. A couple of U.S. life science investors, a couple of U.S. mutual funds, and then but the predominant part, about 35% of that, are Canadian. I would say more generalist investors. Canada doesn't have a lot of specialist life sciences funds. So primarily Canadian generalist investors, whether they're kind of closed-end funds. We just had a fund that announced they took about 11% of our shares, so went over into kind of, I see it as kind of a closed-end mutual fund. They see it a little bit differently, but that's a different story. Classic mutual funds, so you can go buy some mutual funds and become a small owner of us, and insurance companies, hedgy kind of funds, and family offices and the like. And then about 25% of our shares are classic public float. A lot of that, to be honest, is held up with long-term ownership that people have been owners for a long time.
Yeah, no, I think you guys are the textbook case of sort of, I'd like to think smart retail had significant ownership. You guys have grown into a bit of a Canadian institutional darling as far as microcaps go. So you've kind of managed it, I'd almost say you choreographed it perfectly. Like I can't argue with anything you've done. So, and yeah, I mean, we're pretty happy with the performance. So, I obviously I can't say anything bad about what you've done here. Now, you guys are covered now. Back when we first met you, you didn't have any coverage. You were the only guys that did any kind of coverage. But a handful of groups on the street cover you guys. Maybe mention a few.
Yeah, so we are fortunate. We have actually excellent coverage. At the risk of forgetting somebody, I'll do it alphabetically as I remember. So we're covered by Acumen, Beacon, Bloom Burton, which is a specialist life science fund. So our investment bankers, so many of the participants on the call, listeners may not know them. Canaccord, Cormark, M Partners, Interactive, and I'm forgetting one. PI.
Maybe it's just easier to mention who doesn't cover you. I think that's probably the easier way to do it.
So we've got very strong coverage, and I would say that second tier, the quality of the second tier, not the big banks, but the next tier of that, and we're fortunate that we've been. I think. One of the reasons is we're an unusual stock on the venture, but we generate revenues, we generate profits. We've grown pretty significantly, and there's essentially also in what we specifically do, there's a scarcity value. There aren't a lot of ways to publicly invest in the demographic trend of assisted reproduction. So if you want to invest in assisted reproduction, you don't have a lot of choices. One of those larger competitors I mentioned is Vitrolife. They're traded on the Stockholm Exchange. They have a valuation of roughly 15 times sales. We're not cheap by, so we're cheap by that standard. We're not necessarily a cheap stock at 3.5-ish times sales, but those are your choices. If you want to invest in the providers of products to the IVF clinics, there are a couple of not anyone in North America public deals and at the clinic level, and then some very things around the edges. But I think that's one of the things that makes us interesting. I know at least one of the banks that has followed us for some time at Beacon, the analyst there has strong demographic themes behind a lot of things. Follows funeral homes and IVF, but there aren't a lot of opportunities to invest in these really long-term demographic changes and trends that augur well for, again, as I said earlier, for our continued growth.
Perfect. So we're going to wrap up shortly, but as always, we always like to ask if there's anybody that has questions for David, just to add them to the chat box. I know David's done a fantastic job of sort of answering a lot of my questions before I asked them. But before we get to sort of summarizing everything, I mean, this is now starting to look like a perfect NASDAQ listed company. When and if or is that something you guys are going to look to?
Yeah, so as I mentioned earlier, we're U.S. headquartered, so the thought of a NASDAQ listing is very much a natural thing for us to do. I've been officer and director of a number of publicly held U.S. companies, as has our CFO, has been CFO of NASDAQ listed companies. So the idea of doing that makes perfect sense to us. That being said, and going, for as long as we're doing our history lesson, if you remember when you found us, we were this, completely unknown, abandoned, orphaned TSX company because we were just too small. Maybe, performance wasn't quite what it is today, of course, but just too small and under followed. So clearly, the last thing we want to do is go from being, a well understood, well regarded Canadian, stock with a lot of institutional ownership to an orphan on NASDAQ. So, I think the key is to do it at the right time and in the right way. I think in terms of market cap, we're pretty close to where, we're clearly to the point where we could go. I think there's enough size and demand. We would be in the Russell 2000 was recently reconstituted, so we would be in the Russell 2000, which is an important milestone if you want to get, liquidity you want. So you get always that kind of trading for good or bad, because they're just rebalancing. They're not making decisions about your shares, and I think there's enough interest from a banker perspective, but it really, in our view, to be successful, has to have the interest from the institutional holders. And that means that, the institutional, the number of institutions in the U.S. is huge, and the size of the check they want to write is much bigger. So we'd have to, to do it right, I think you've got to do a listing, couple it with an offering, either in the same time or in short succession, and have it be small enough so we don't over dilute our shares, particularly if we don't necessarily need the money, but big enough so we can get some of those really top tier, some of the top tier ownership that we've gotten in Canada.
Perfect. David, you've done a fantastic job today of informing us and sort of pre-answering all my questions. Why don't we take this? Oh, we do have a couple questions here. Okay, here we go. What does Hamilton Thorne look like in 5 years?
Maybe I can answer it. That our playbook over the last 5 years, we've basically quadrupled the size of the business, significantly improved profitability, expanded product line, and continue and become much more greatly developed our worldwide footprint from a direct sales team. We are continuing to execute against the exact same playbook over the next 5 years. I don't want to, I can't promise you numerically how it's going to turn out in terms of what that growth will be or what kind of improvement to profitability you will see over the long term. But we clearly believe that those are, those avenues are all available to us, and that's the plan we expect to execute.
Perfect. There is another question here, but it revolves around more, what else do you think you guys need to do to sort of grow your business? Whether it's, is there some additional management or any other parts of your business that you really want to add to, outside of M&A, that you think you need to shore up to improve the business?
No, I think we've actually got a great management team. As I mentioned, at least in the context of uplisting, which is often why people need to think about management. Both our CFO and I have been involved with and managed NASDAQ listed companies, so we understand that side of the world from a both regulatory side and a behavior side. So I think that part is strong. As we continue to grow the business, you asked the 5-year plan. So if we were to double again, I'm sure there will be additional opportunities to add to our staff. And so I wouldn't say it's really to fill gaps, but that there will be new things that as a business of a different size, you just have to address in a different way. So I could certainly imagine those happening. But today I feel we have a very strong, we have a very lean, we run lean, but a very strong, corporate team. And then at the local geographies, really strong general management who run those territories and the operations that are in those territories very, very effectively.
Fantastic. David, one last opportunity to sort of give our listeners, investors, an understanding of what they can expect over sort of the next 6 to 12 months. And if there's anything we sort of missed that I didn't ask, have at it. Just tell us what to look for.
Yeah, so I will tell you, with the preamble, that one of the things that makes us also a little bit different is we're not a catalyst-driven business. So don't look for this, this specific event that's going to, cause some great hockey stick in either our shares or our value. Our game plan for the balance of 2020 is pretty similar to the game plan we had last year, and my guess is pretty similar to the game plan we're going to have next year. We want to continue to generate strong, profitable growth through a combination of organic growth, faster than our market is growing, and augmented by acquisition that accomplishes all the things that I talked about on the acquisition front. We are continuing to reinvest back in the business. So we're not going for maximum operating leverage. We're going for maximum reinvestment in the business consistent with decent earnings, and investing in sales and marketing resources, sales and marketing, particularly digital marketing events and activities, product development, new service offerings. So we're even in the context of COVID, which makes you cautious on the one hand, we're still very bullish and continuing to invest in the business. And I think again, whether an uplisting happens in that time frame, I don't know, but we would certainly continue to do this kind of outreach. We spend not a huge amount of time, but some time doing expanding our investor outreach, particularly in the U.S. We are doing 2 U.S. conferences. Now they're all virtual, so I guess what is anything a U.S. conference? In one in the August timeframe and one in the September timeframe, the Canaccord conference and the Wainwright conference. So again, getting more visibility, particularly into the institutional investor community in the U.S. And we would expect to continue to do those things while at the same time supporting our Canadian ownership as best we can.
Fantastic. Well, David, if the next 5 years is anything like the past 5 years, share price, I know you never promise anything, but you always over deliver. So I'm happy to take on the guesswork here. One more time, where can investors get more information?
Yeah, so again, our listing is HTL on the Venture Exchange. We're also HTL-ZF, which is an OTC listing. We don't put a lot of effort into that. It doesn't trade that much, but for U.S. investors, you can go to your local discount broker and just buy the shares if you want. And for the corporate investor site, it's Hamilton Thorne, THORNE .LTD. And that is essentially our investor-oriented site. Fantastic.
Okay, David, thank you so much for joining us today. Really appreciate it. Like I said, you're an SCD stock that we will remember forever.
Well,
and appreciate it. Trev, I'm going to hand it back to you, and you can wrap up.
All right. Well, my pleasure to have presented. Thank you very much for the opportunity, and hope everybody continues to stay healthy and safe.
Appreciate
Yeah.
it.
Perfect. Thanks a lot. Thanks a lot, David. And we'll be looking forward to a number of future acquisitions coming out of the business.
All right. Thank you again.